Employees appreciate the long-term incentive of equity compensation, but are often confused about how to even use it. For any business owner or operator, you might prefer to issue rights and warrants, convertible notes, or a deferred compensation plan, any other way to be creative about avoiding dilution and taking on bad debt. Then there's the board of directors. They have grand expectations of execution, business development, scaling the operations, and achieving targets that are going to be tied to their own performance bonuses. And then meanwhile, you've got the shareholders. They have clear expectations about how their capital is going to be put to use effectively to achieve a fair return for the risk that they're taking on their investment. So you could say at best, it's a real balancing act. At worst, it's a mess. We're going to show you how to thread the needle between your personal development plan, your fundraising capabilities and your fundraising rounds from early stage through the business lifecycle, and designing the equity compensation strategy to properly align incentives. And here's the real goal here. You don't want this to be this rehearsed line that you say when you're on the shareholder call. We have a team, we do teamwork. You don't want it to be this over-rehearsed thing, and you don't want it to be this throwaway item, this pamphlet of information you get through HR and onboarding that you look at once and then you never look at it again. And then by the time you want to exercise a stock option or a restricted stock unit, you don't know what to do. You're not even working with your business anymore. You're going to some outside third-party financial advisor. Okay, so the value proposition here is to work with a family office like ours that has development experience, business development, private equity, business planning, financial modeling, and all of it from the whole life cycle from founding through exit. You want to work with people like us, and then we have a wealth management arm that can advise your staff on how to maximize benefits of this plan. So let's dive in. The origin here is that we kept encountering owners and operators in private equity that were confused and wanted to either redo how they designed their equity compensation, or they wanted to see if there was any flexibility. And at the same time, we were working with employees from the same private equity groups that were confused about how to exercise. And it just got us thinking that even though this is an equity compensation presentation, an idea for the design for private equity, this has implications for private enterprise and public equity as well. This whole process needs to be done better, threading the needle between all of the different sides and all of the different incentives. My name is Jeff Sokol. Today is August the 20th of 2024, but this will stay relevant, I'm sure, for many days, many weeks, many months, and even years to come. Equity compensation, a form of payment where employees receive shares or stock options in a company as part of their total compensation package. Instead of receiving just a salary, employees can get an ownership stake in the company, which can increase in value if the company performs well. And might look better on your balance sheet because instead of forking out cash all day, every day, you're giving out equity, and otherwise that equity might just be sitting on the shelf in the treasury. So this obviously has some positive benefits for all parties. What we're going to do here, we're going to follow the why, what, and how methodology. Why does it matter? What does data show us? How to design it? And then the value proposition for working with a family office to achieve that benefit. Starting with the data. Okay, so we're looking at numbers here. So this can really pack a punch. Increased productivity. 21% increase in productivity for employees with high morale. The reduction of turnover, high employee morale, correlates with lower turnover rates. 59% less likely to seek a new job compared to disengaged employees. Enhanced performance, 17% higher productivity, 21% higher profitability. And these are all by Gallup polls, by the way. And customer satisfaction. So these people that are externally facing the outside world, employee morale can impact customer satisfaction. This is by Harvard Business Review. Highly engaged employees improve customer service, drive better customer satisfaction scores, increasing the customer loyalty and ultimately the revenue. A couple more. Lower absenteeism. High morale and engagement are associated with lower absenteeism. 41% less likely to miss work. Okay, and improved safety. Engaged employees are 70% less likely to experience safety incidents. So that's interesting from an insurance and liability and insurability perspective. So, point being, these statistics underscore how a committed long-term workforce with high morale can lead to significant improvements in productivity, profitability, and overall organizational health. And the point we're trying to make is this has a lot to do with how they are compensated. Salary and benefits matter, and that's why equity compensation matters a great deal. Something that I see all the time is in the early stages, there is such an emphasis on getting the capital in and figuring out how you're going to scale, how you're going to get your annual recurring revenues up, that these other items, they either slip through the cracks or they're not given the amount of attention to detail that's required to ultimately be in this for the long haul. You got to think more than 3 or 6 months in advance. And I know it's difficult. As a business, you're thinking moment to moment, day to day. It's a fight to survive, just to stay above water sometimes. But you have to also have someone on your team, someone in your corner who's thinking, look, we've got 7 to 10 years of runway here. Let's do this right. And the difference, businesses, they operate at the margin. If we're making 1 or 2 or 3% of a difference in how this is designed, that shows up. That's going to show up in your profitability and on your net margin. So this is something you really got to keep in mind, especially when it's coming to the key personnel that you're trying to attract. You're trying to source them, you're trying to engage them, and you're trying to retain them. Because if you can't do that, it's going to be very difficult to scale, and then you're back to square one. We need more capital in. We got to figure out how we're doing it. And a top five for me in my world, I'm looking at what does the cash flow look like? What does the balance sheet look like? How much revenue are you doing? And then I need to see the personnel. Who's in charge around here? So we're talking about key executive level, board of directors, the competence of the management, but also the key personnel, the staff, the heartbeat of the company. So we're looking at the top five there, and how many pitches, 99% of them that you hear, yeah, it sounds interesting, but I don't know, pass. You gotta really cross all your T's, dot all your I's, and equity compensation is certainly a part of that. Okay, we've done our kumbaya about crossing your T's, dotting your I's, getting all buttoned up. Now let's think about the actual money. Let's think about what this is actually doing to the cash flow and to the balance sheet. Let's think about recruitment and training. The cost to recruit and train a new employee can be substantial. Replacement costs up to 50 to 60% of the employee's annual salary. The loss of expertise, the loss of productivity. Losing a skilled employee can lead to a temporary decrease in productivity, a loss of institutional knowledge. All right. Impact on team and team morale. High turnover can negatively impact team morale and cohesion. Further productivity losses can be expected, and then you'll get additional turnover, so you end up in a cycle there. Then there's the customer impact. Client-facing roles. Turnover can affect client relationships and client satisfaction, and then they might take their business elsewhere. Not to mention, number 5 here, the operational disruption. Okay, turnover of critical roles can lead to delays in projects and operation, and then that's going to impact the company's ability to get things done on time and on budget. Let's think about the design of the equity compensation. We're going to start with an overview, define the objectives. And I think from what we've just covered in the past couple of minutes here, we understand the objectives. The goals of the compensation plan are going to be to impact the productivity and the profitability of the business. Let's just, let's say it like it is. Now, the size of the equity pool, often 10 or 20% of the total company shares, can be allocated to a program like this that is ultimately going to be for the benefit for the employee. Okay, large enough to offer meaningful stakes, but balanced enough to avoid excessive dilution, and that's where we're going to do this this balancing act between the employee, the founder, the board of directors, and the shareholders. All right, then we're looking at the right instruments, and this is the stuff where I end up seeing guys with this equity comp going to financial advisors who have no skin in the game, and it's this weird conversation where they're like, okay, so what do you have? And when do you want to exercise? And it's like so devoid of what's going on at the company. And that always just seems strange to me. So we're going to talk about this in the value proposition later about how you can have the same team that designs your equity compensation can be the same guys that are helping your employees exercise. So there are going to be stock options, restricted stock units, stock grants, and there may be some other type of incentives like incentive stock options, or non-qualified, and there could be deferred compensation. There's a whole variety. Then there's a vesting schedule, and the idea here is to choose an appropriate date so that you're going to ensure the employee stays long term. And let's just call it like it is, the old golden handcuffs, right? You got to stick around long enough to realize this profitability. And then setting the exercise prices. So here's where you're getting out the calculator and you're doing your math that you want the price to be far enough into the future that we're not going to realize it right away, and then they have the incentive to try and get the company to that share price to realize this benefit, but not so far away in advance, not just on the schedule, but if it's 10x the current price, then it's not going to be realistic versus just buying in the open market. So that's where you have to have your calculator out and be diligent. Think about the eligibility and the allocation. So who is in on this? And it can be the founders, it can be the board of directors, it can be a hired gun, so to speak. It's not just the employees. So this is again thinking about who is eligible and how much they should have allocated, and the reasons for that, so that your HR and your onboarding process can explain that clearly to people. We talked about fair market value just a moment ago. So again, having your calculators handy to be able to do this correctly and properly. Big one, big theme. Number 8 here, communication needs to be clear, and your employees should know how to exercise. I think it's so bizarre that these guys are coming up to me, hey, I work with Northrop Grumman, I have all these stock options. And I'm like, don't you have a person over there to tell you how to do this? Like, no, I don't know. We just have a guy who tells us what to put our 401ks in. And it's like, that's a whole other conversation too. I wonder what your expense ratios are, how the 401k is performing. That's a whole different thing. The legal and tax considerations. This is an important one because a lot of people that start businesses are not accountants. They're not lawyers. Okay. So, effectively being able to outsource some of that work is always good. And then the ongoing review and adjustment to make sure that things are performing adequately the way they were designed to. And if you need to make any adjustments, building in some flexibility at origin can always be a good idea. But also, you could buy a small business and they could have already designed an equity compensation. And, what are you even reviewing? What are you even adjusting? You barely even know why it was designed. And I'm sure some of that could be handed over from the sale or from the buy side, sell side transaction. But still, you're taking over this business. This might not be the first thing on your mind. I want to see the revenue. I want to see the balance sheet. And it's like, I want to see the equity compensation. Well, hey, in your due diligence rounds, that is going to be important. So having a family office, as we're going to get into in a moment, is going to be helpful to you. So if I could make one really key central point about the whole concept of equity compensation is about having freedom and security to do what you got to do and what needs to get done. And this is for anyone in any role. If you're the investor and you just want to know that this company has done a fantastic job and has been very detail oriented, then great. You can just be a passive investor, put your money in, take it out when it's appreciated. For the guys in the business, an employee, it's challenging. It's stressful, when times get tough and you have to tighten up the belt and you don't know, should I exercise, should I not? Having a plan, having it be a very coherent part of your process takes the load off. Freedom and security for the shareholders, for the employees, for the founders. You got to focus on what you need to focus on. You have to grow the business. You have, let's be honest here. You have a pretty key obligation to keep growing revenues, keep achieving your targets, keep everything operationally efficient, and keep developing the business. It's not the type of question you want to get about, how does this RSU work? And then it's an inefficiency in the business when no one knows how to answer that question. So that's a big part of it. And then making sure that your own compensation is adequate. And this was a big thing if you guys remember back to the 08, 09 financial crisis. The amount of money these guys were making with their predatory lending, and they were completely absolved of any blame. Like the credit ratings giving these triple A ratings to this absolute junk. Everyone had absolved themselves of any culpability, and these, like, oh my God, there was guys making like $500 million a year at Goldman Sachs, and then next thing you know, they were getting appointed to being Secretary of the Treasury. Um, so I don't mean to get off topic here, but make sure what you're doing has legal merit and there's a good framework for what you're slicing out for yourselves, because God forbid if things go south and the ship is taking on water and there you are vacationing in Ibiza, it's not going to be a good look. And even if you get a out of jail card, it's going to be tough for you to get back into the business world after something like that happens. So making sure that everything is done properly for the maximum benefit so that you're always operating from an advantageous position, that's what we're trying to do here. And that's what you can do, taking something like equity compensation and scaling that out to how you operate as a whole, holistically. That is the family office approach. So let's get into the value proposition there. Something I often tell to people is that I'm not a salesperson. I would like for us to work together, but even if we do not work together, I advise that you do this anyways, whether it's with me or with someone else, because what I'm talking about is valuable. So keep that in mind, as it says, partnering with our family office offers private equity companies a unique advantage through our deep expertise in business development and equity compensation strategies. Um, so I would, you could replace "are" here and just say "a family office" and make sure that you're going through this exercise. But just thinking about the tasks that you'll have the ability to outsource, we're looking at social responsibility, transactions, bookkeeping, and this is accounting, the educational side of things, managing your advisors, being a quarterback, tax strategy, working with different accountants that have subject matter expertise, succession. So this is your own business planning and estate planning. Thinking about we on average we work with 2.5 generations per client. Think about that. Then structuring things, the wealth transfer, to do things efficiently, the governance process, and estate planning is in there as well. So this is what we're offering, and we could just link up to design an equity compensation strategy, but that's all the extra value and other services that we're going to be able to provide you in what will ultimately be a customized strategy, because there is no one size fits all, with in-depth market knowledge, because we've worked with thousands of clients and we've done every stage of the business life cycle, different countries, different industries, different sectors, different sizes. So, we're not just numbers guys. We actually have built businesses ourselves, and we have some expertise, potentially directly in your industry. Doing it with a holistic approach, we take the whole person into account. So not just the business, not just the numbers, not just revenue, we're going to be looking at everything and seeing what we can do to help you, your spouse, your children, your parents, your children's children, whoever it may be. Doing so efficiently. And I think efficiency is an important topic in general here, because uh, you might be able to make more money, but you'll never be able to make more time. So if you're being pulled in 100 different directions to do 100 different tasks, wouldn't it be better to just allocate something of a quarterback to handle this for you? And that's what a good advisory team can do. And if that advisory team has the expertise to also be building your business plans and managing your wealth, then, for goodness sake, why wouldn't you do it? So just to categorize that, we could do wealth management, portfolio management, investment selection, the legal services, the accounting, the tax, the governance, excuse me, and then the lifestyle management, to make sure that, you're also not getting so in depth into the weeds into your business that when it comes time to think about exit planning and exit strategy, that you're not so tied up your identity. Um, we've worked with people that have been doing 10, 15, 20 hours a day for their business for, gosh, 10, 20 years, and by the time we start talking about exit planning, they're like, I can't leave my business because I don't know what I'm going to do otherwise. And it's a more relatable problem than you would think, but that problem's not going to go away. So you have to start thinking about it at some point. For goodness sake, you want to have some hobbies, even something simple. If you just start, gardening in the front yard, or, I wouldn't suggest you start collecting model trains per se, but, getting involved in the community and seeing if there's some charitable causes you might be able to get involved with, or things of that nature. Okay, and then strategic alignment, to get back into the concept of equity compensation, making sure the different stakeholders are aligned, maximum incentive, maximum benefit, always in a position of relative strength, operating advantageously. And then this can be a good exercise in risk management, thinking about the insurability of your business and having key man policies in a literal sense as an insurance policy, but also making sure you're protecting your key men and women, that they're going to stay in the company. And then you're going to be creating long-term value. So it's always a great thing when you are ahead of schedule and under budget. And this is one of the ways you can do it, is by attacking that future problem with good planning in the present tense. Now, if you would like some numbers, case studies, if you would like us to run a complementary analysis or build something for you where you can actually see our planning software and our tools to see how the numbers go in, and you can see which inputs we use and how we can, develop a neutral bear case, a bullish case, and see how that all works. And if it looks good and if you'd like to run it, then we can. But, at the very least, you can get numbers, you can look at our case studies, we can provide you a complimentary analysis, and the contact information you can find me below. I'm pretty active on Twitter or LinkedIn, or you can email me. And please, don't be shy, don't be a stranger. We would be happy to help. And there is a lot of power in identifying what's in the blind spot. All right? You don't know what you don't know, and sometimes what you don't know can hurt you. Okay? Thank you guys for watching, and please don't be shy, don't be a stranger. We would be happy to help. All right. Take care.